Hi everyone! Today we are diving deep into a sector that is often called the backbone of Indian manufacturing, pharmaceuticals. But while everyone is busy tracking the blue chips like Sun Pharma or Dr. Reddy's, there is a small cap player quietly capturing massive global market share. We are talking about a company where 60%
India is the global pharmacy of the world, and for good reason. Our pharmaceutical industry is currently valued at nearly $50 billion, with a growth trajectory aimed at $130 billion by 2030. But the real story is in exports. This specific small-cap stock is not just selling locally, it is competing on the world stage. They have established a footprint in over 45 countries, including the most stringent regulated markets like the US and the EU. Why does this matter? Because export margins are typically 30 to 40% higher than domestic sales. When a small company masters the complex logistics and regulatory hurdles of international trade, it creates a massive competitive moat. They aren't just selling pills, they are selling Indian engineering and quality at a price point the West cannot match.
In the world of pharma, your manufacturing facility is your resume. Our featured company boasts 3 US FDA-approved plants, a rare feat for a small-cap entity. This compliance is the golden ticket to the US market, which remains the world's largest healthcare consumer. Their portfolio is focused on niche APIs and specialty generics. Instead of fighting in crowded markets like paracetamol, they focus on high barrier-to-entry segments, where competition is low but demand is constant. They currently hold 15 active ANDAs, which are abbreviated new drug applications, and have a pipeline of 10 more under review. This signifies a clear roadmap for future product launches. For an investor, these approvals are indicators of long-term sustainability and a shield against the volatility that usually plagues smaller companies. Let's look at the hard numbers, because as we say, data doesn't lie. Over the last 5 years, this company has maintained a revenue CAGR of 25%. Even more impressive is their EBITDA margin, which stands at a solid 20%. Many small-cap stocks struggle with debt, but this company is virtually debt-free, maintaining a debt-to-equity ratio of just 0.1. This financial discipline allows them to reinvest their internal accruals into expanding their manufacturing capacity without diluting equity or taking on high-interest loans. Their return on equity, or ROE, has consistently stayed above 18%. For those of you looking at fundamental health, these metrics are characteristic of a mid-cap company, yet it is currently being traded at a small-cap valuation. You might ask, if the company is so good, why isn't everyone buying it? The answer lies in market perception. Currently, this stock is trading at a price-to-earnings ratio of only 12 times. Compare that to the industry average of 28 times for Indian pharma. Why the gap? Firstly, liquidity. Large institutional investors often cannot enter small-cap stocks without moving the price too much. Secondly, the lack of analyst coverage. Very few brokerage houses are currently tracking this company, which means it hasn't entered the hype cycle yet. For the individual investor, this is a distinct advantage. You have the chance to enter at a value zone before the rest of the market catches on and re-rates the stock to its fair value. This is where wealth is built, finding value before it becomes obvious. The secret sauce of this company is its vertical integration. They produce their own key starting materials, or KSMs, which reduces their dependence on imports from China. In an era of supply chain disruptions, this is a massive strategic advantage. By controlling the production from the raw material to the final formulation, they manage to keep their cost of production 15% lower than their competitors. This efficiency is what allows them to maintain that 60% export share. They can offer competitive pricing in Europe while still pocketing healthy profits. Their R&D spend has also increased to 5% of their total turnover, ensuring that they stay ahead of the curve in developing complex molecules that others find difficult to manufacture. Every investment has risks, and it is my duty to highlight them. For a pharma company with high exports, the biggest risk is regulatory action. If the US FDA issues a warning letter or an import alert on any of their plants, it could significantly impact the stock price in the short term. Additionally, currency fluctuation plays a big role. Since 60% of their revenue is in dollars and euros, a strengthening rupee can eat into their margins. Finally, there is the risk of price erosion in the US generics market. However, because this company focuses on niche products and not high-volume commodities, they are better protected than most. As an investor, you must weigh these risks against the massive growth potential. Diversification is always key when playing in the small cap space.
So, what is the final verdict? We have a small cap pharma stock with 3 U.S. FDA plants, a debt-free balance sheet, and a dominant export presence. It is currently trading at a significant discount to its peers. For the long-term investor, this represents a classic growth at a reasonable price scenario. As the global demand for affordable healthcare rises, companies that can deliver quality and cost efficiency will be the ultimate winners. Remember, investing is about patience and conviction. Do your own due diligence, consult your financial advisor, but don't let these overlooked gems slip past your radar. If you found this analysis helpful, please like the video and subscribe for more deep dives into the Indian market. Let's grow our wealth together, strategically. Thank you for watching.